This will be a special interview. I am joined by an investor, hedge fund manager who prefers to stay private. So we will only be referring to him by his Twitter handle at Citrini7. Citrini, great to have you on. Can you tell us a little bit about your investing style? What kind of assets do you invest in and why?
Great to be on, Jack. The answer to my investing style is everything, and the answer to the kinds of assets that I invest in is everything. Basically, I started this about 5 or 6 years ago. I sold my business and I was instantly enamored with the market, right? My business was in a very, you could call it a bubble, right? Like a frothy sector. And I sold essentially at the top, right? It went public and, I sold at the top essentially and, generally watched as, it was a 90% cash, 10% stock deal. But I watched as the stock basically, tripled my net worth and then immediately cut it in half. So that's kind of like a life experience where you're like, what happened? Right. And I started, getting more interested in managing money and basically developed a framework for investing that captures my fascination with markets, right? In every single market, they're all interwoven. And I have basically the philosophy that originally it was just me managing my own money. And my philosophy was if I find $1 selling for 50 cents, I'm going to pick it up. And then when, COVID happened and, I didn't take a drawdown during March 2020, and some of the people in my network got kind of interested in me running money. So now it's very tight knit, just me and a couple people. But that's basically what I've been doing, and my framework is essentially use a cross asset kind of approach to get hints about different markets, right? Well, obviously, we know what's happening in the bond or treasury market is going to tell you a little bit about what's happening in the equity market, but also internationally, right? Where is the money going? Where just that's basically what I do. And I don't think I'm not great at like talking about my process, but you've seen some of the trades. A good example, I think, is the Silicon Valley Bank thing, right? Like I am a generalist at heart, and I'm not a bank analyst, but I think that also the way that I came into this wasn't through Wall Street. I don't necessarily have a financial background, but I was approaching it, I had a portfolio that was very, very levered to the fact that we weren't going to have a recession. And I needed a position that was going to offset that kind of not recession exposure. So where do you look, right? Well, the banks. So, I went through, and that's how I ended up finding Silicon Valley Bank, which I shorted, in August.
I forgot that you shorted about that. Yeah, I should say. So, Citrini, you've had a
I thought that's why you were interviewing me.
no. I've done tons of bank interviews. I want to talk about AI. You had a very hot hand in AI stocks. I mean, you tweet tickers on stocks, in February and March, and some of them are up 70%. Some of them have more than doubled since then. We can talk about a few of them. So I even forgot about the fact that you shorted Silicon Valley Bank. So your cross asset class. You trade anything wherever you see an opportunity. Yeah, let's talk about AI. I mean, you have a lot of stocks absolutely popping off. The most conspicuous example is probably Nvidia, which is up something like 180% this year, and that's causing people to say, "Yep, it's a bubble. This is a bubble. You
Well,
should stay out." Why are they wrong? Citrini's image is blurred, so I'll describe what we're seeing. First of all, he's wearing a suit and tie. He looks very nice. He's got a guitar in the background, and then he just picked up a book that was The Alchemy of Finance by George Soros. So that's why he's wrong. Okay.
Soros, everything he's written is a great framework for how to view bubbles and bursts. He has that famous saying that's when I see a bubble forming, I rush in and add fuel to the fire, and that's not irrational. It's interesting right now because there's this dynamic in the market that is almost like post-traumatic stress disorder, or like post-traumatic asset inflation disorder. Growth was such a major theme for a decade, right? And now,
growth stocks, yeah,
yeah, exactly. Technology, growth stocks, innovation. Then what happened is what happens in every bubble, and they kind of deflated, and nobody can really watch an investment, lose 70% of its value and not have a psychological impact. And I was also very bearish on technology for, all of 2022. Inflation, the Fed had to raise rates, and that was that. Sometimes it's as simple as that. But the thing is, now you have a genuinely promising technology that, AI and machine learning are not new. They've been around for quite some time. It's just that they have reached a tipping point. Things can exist for a very long time, and then they enter the public zeitgeist and the public consciousness. And what occurs is they experience exponential growth, right? And the initial driver, right, is what I call like corporate FOMO. If your biggest competitor is implementing artificial intelligence and machine learning, deep learning, you're going to too. I'm sorry, I got one off at a tangent. The original question was
make the case for me. Okay, so
right. So, well, firstly, right, even if it is a bubble, it's a relatively new bubble, and catching a bubble is the best possible financial decision. Being long in the beginning of a bubble is the best financial decision you can make in your entire life. Right? Just because it's always amusing to me when
if you get
people
out in time,
say, okay, if you get out in time, I mean, if you pull up a chart of like ARC innovation or something, right? How long was, if you caught the beginning of ARC's parabolic rise, right? How long was it going down for before it went below your cost basis?
It happened pretty quick, I think.
I think it's
generally the point you're making is right, but in the case of ARC, which I'm pretty familiar with, it happened pretty quick, like within a year, definitely.
Well, yeah, okay, within a year, but I mean, we're traders, where we see what's
okay. So if you bought at the bottom, well, you're not going to buy at the bottom. Let's say if you bought in May 2020 at $62 on ARC, it took March 2022, 2 years.
And how long was it going down for?
The peak was in 2021, and then it faded out. But you know how trading is, and I mean, you're probably better at trading than definitely me and the average person, and probably a lot of people listening. But like, you know how hard it. No, you never.
Sure, but
the lower it goes, you're like, oh my god, it's cheaper.
So yes, I suppose you're right. If you get out near the top, right? But at the same time, if you're talking about a bubble that's a bubble, I don't want to invest in it. Really, what you should be saying is that's a bubble and it's about to pop, and I don't want to invest in it, right? Like, and also furthermore, bubbles are probably the best, well-researched phenomena in all of finance, and they have a set of criteria that comes along with them, and one of them is IPOs, syndicates, and SPACs, for example, right? And pre-revenue companies that are valued at billions and billions of dollars, and literal companies that are piles of $700 million that are trading on the stock exchange for 1.4 billion. That's because there were SPACs, right? That were trading at 100%.
Yeah.
I mean, that's
and everyone is talking about how they got to buy GameStop, huge retail. Everyone wants to talk to you about stocks and the next hot thing. We're not there yet. And I think you're absolutely right, and that's why I think I have a feeling, my own suspicion is that these stocks could continue to go higher. And I don't know enough about the fundamentals, but that's just kind of my observation. So I'm not necessarily disagreeing with you. I just, for the sake of argument, I want to play the role of a skeptic, because I know there are a lot of skeptics out there.
There are a lot of skeptics.
So Citrini, so this whole chat GPT, it gets popular, everyone who was, into crypto in 2021, suddenly they're a, AI genius expert, and they're all talking about this. Okay, how does this actually change the game? So like NVIDIA skyrockets, what is going to be different? What is different in this new world where artificial intelligence has reached, as you say, a tipping point that is different from 2018? Why should these stocks be trading at 70 times earnings instead of 20 times earnings?
So your question, what is different in 2 years' time or 3 years' time because of artificial intelligence or machine learning? I don't know. I have no clue. All that I know is that artificial intelligence and machine learning exist. They are, accelerated computing and parallel computing is a new paradigm in computing. And just by the fact that it exists, it's growing at 2,000% year over year if you annualize it. Nothing. This is a quote directly from Jeff Bezos. Nothing grows at 2,000% year over year and
So
doesn't.
what is growing at 2,000%?
If you look at OpenAI's numbers, like the week over week, if you annualize it.
Oh, users of ChatGPT, yeah.
Right, and users and developers, right? But so here's the thing: I'm not smart enough to know what the world looks like in 2 years. I don't know where this technology is going to be most beneficial. I don't know where it's going to be most harmful. All I know is that it exists, and the nature of it existing, inherent to artificial intelligence and machine learning, is the fact that it takes an intense amount of computing power, right? It's a new paradigm in computing in that, if you have a CPU, or you have a CPU, so a CPU can do a lot of tasks, but not side by side, right? It can make a ton of calculations, very complex but it's limited by the number of threads it has, the number of processes. Whereas a GPU, right, can that's what you might have heard the term like teraflop or exaflop, FLOP, floating point operations, right? It's basically like calculating, and this is why it was used in cryptocurrency, but a lot of the cryptocurrency miners, they're specifically for cryptocurrency. Regardless, just by the nature of this existing means that data centers are going to have to change and grow exponentially to accommodate its use, right? That is what I'm focusing on. Or, the thing that brought me to this was I wasn't like seeking out for a new type of innovative technology. I was pretty pessimistic about, innovation after, obviously the Fed funds rate is at 5%, and, we might be going into a recession. We might not be. But the thing is, I still am in the business of, finding things that are trading cheaper than what their true value is. And I bought a company called Supermicro computer, and it was very contrarian at the time that I bought it. It had some accounting irregularities, which is like the touch of death in the stock market, right? And I think it was trading at 2 or 3 times its free cash flow. It was very, very, very cheap. And then, I held it. The position was probably up, I don't know, 100% or so. And that's when ChatGPT came out. When I saw it, I was like, this is kind of a big deal. So I was going through my portfolio to kind of see, and that kind of got me to learn a little bit more about this. And the fact that, it is a beneficiary because data center, we're not going to completely get rid of CPU computing. We're just going to, we need more GPU servers, and GPU, Supermicro makes those servers. So that kind of got me thinking about what is the best risk reward in this entire space. And the best risk reward, obviously if you right now can predict who is going to be the biggest beneficiary of the AI, machine learning, deep learning as a technology, I think that's amazing. And, your rewards are going to be absolutely insane. Like, buying Apple right before they released the iPhone in one parabolic, or, buying Microsoft before they released Windows, or buying Google before they won the search wars. I mean, but the thing is, I'm not advanced enough to know what that is. So the best risk reward for me is to say, who are going to be the people that build the rails that this technology goes along? And it's the data centers. And that's, I wrote a piece recently that I sent to you about trying to find out who the biggest beneficiaries of this are. And I lay out, kind of a framework, basically 3 phases, right? And it's not linear. These phases aren't going to happen one after the other. The first phase is obviously like a data center hyperscale, right? The data centers are the bottleneck in this situation. They have to, if every single company, developer, startup that decides they want to use artificial intelligence or machine learning, That's more computing power that's necessary. So that needs to scale first. That's the gate. And that, I think, represents the best place to be. Phase two, there's going to be the implementation. Now, do I want to be long the names that are implementing AI? Palantir is one of them. That's up huge. That would have been nice to be long, but I don't know if in 2 years it's going to look the same way it does. I don't know if they're still, if they're going to be a winner or a loser. There are vague threats to software companies. So instead, you look at companies like, Google or Adobe or the companies that are going to take AI and put it in the hands of people. Finally, you get to, phase three where people will specialize and integrate it. And it will see increasingly specific use cases. And there are some specific use cases now, like the company Schrodinger or Abcelera. They are using artificial intelligence for drug discovery, right? Deducing structure activity relationships in new chemicals. And that's first off, that's amazing. Any biotech investor that's listening to this, how much R&D, how much spending is done just finding the molecules, just finding the structure that's going to work. And imagine that process is streamlined. And, that I think here's the thing. The way that I'm playing this, I think a good way to describe this is like a optimism barbell, right? I have my concerns on the macro situation right now. And I think that there are very valid concerns. Also, there are, potential risks that the market isn't pricing it at all. What if inflation reaccelerates? The economy, is housing, for example, prices are starting to tick back up again. And that is not necessarily what the Fed wants to see. And so there are a lot of macro risks right now, but I think that it actually just contributes to this opportunity because I can have on positions that might maybe not benefit, or they're recession resilient, or they're, I can express that pessimistic view, but at the same time, I can, since this is potentially a mega trend, right? I can weight the barbell with an optimistic view of technology, and it's been working, right? I had some pessimistic, actually, both of sides or both of the barbell and the weights are working right now. But I think that right now, basically, a lot of investors they're just afraid to see something new and shiny and go for it, right? Because it's failed so many times. 5G, Internet of Things wasn't that promising. Blockchain, cannabis, there are these phases, right? But eventually a phase comes along and it's not a phase. The dot-com bubble was a bubble, right? But the internet didn't go away. And if you were buying early, it doesn't really matter if you bought, Apple at the top of the dot-com bubble at the bottom, or Microsoft. It doesn't really. So I think that
if you held forever, which is something people very rarely do,
right,
and it's something
true.
and you yourself are something of a short-term trader.
Absolutely, yeah. The feeling that I get that long-only funds or long money is very, very underweight technology, and it seems like that has been changing, but it's kind of like gradual, right? Like a capitulation, almost like a short squeeze. Like the long-only side is getting short squeezed because every single day you're making a decision whether. If you're holding on to something, you're making a decision to buy it. If you're not buying something, you're essentially making a decision to sell it. You don't think that it's going to outperform the things that you're in. So you have these, long-only managers who, if they were successful, rode a massive trend in technology for almost a decade. And now the same things that were so successful are working so soon after they have changed their portfolio to be more aware of valuations and, the macro environment. And that's painful, right? But the thing is, when you have a short position on, the position can go against you only so long before, you blow up and no longer exist. But if you are long only and underperforming, that can go on for very much longer time before you capitulate. So it's kind of like a rolling short squeeze.
It's a squeeze. It's not a short squeeze because they're not short, but it's a squeeze.
Well, it's not, but right, but it's the same dynamic, right? In that they are getting squeezed because uh, a long only allocator is going to basically, there is a decision to make when you are holding certain things, right? And when you decide to hold those things instead of other things, you're basically short those other things, especially if they're continually going up and you're not participating.
Right. So people may be confused when we say that long only are underweight technology. So first of all, let's say the entire market is not overweight or underweight everything. Everyone is adequately weighted to everything in general. When you say long only, I think you mean active managers who want to differentiate themselves from the index. And you've heard the pitch before, and it sounds convincing, and there are good arguments for it. But the data for active equity management is not super strong. Most active equity managers underperform the index. And they do so by saying, "Oh, Apple's 7% of the S&P, Microsoft's 5%. I'm not going to own those. I'm going to own, this pottery company. I'm going to own this auto lender. This, stocks that are no one's really ever heard of, and because they're so smart, those stocks are supposed to go up more than Apple, right? Well, it doesn't happen. Apple goes up more, and this year that's exactly what has happened. I think it's been quite historic. The narrowness of this rally has been in all the stocks that are underweight from the active managers.
It's really insane because you remember like end of the year ahead forecasts, and like the entire sell side is like, this is the stock pickers market. This is the year of active management. And then it's like, no, immediately wrong.
Yeah.
It was an extreme in sentiment in that the way that Apple was like trading at the end, I'm not saying it was super cheap or whatever, but the way it was trading was just hated, like obviously some of it probably had to do with tax loss harvesting, but it just
Google, Apple for sure, but Google, Salesforce, and then Facebook, Meta was trading at a PE ratio of something like 9,
right.
Whereas there are chicken wing companies that have a PE of like 80. So it's kind of ridiculous.
Exactly.
Chipotle has a PE of 50 or something.
I don't want to be the Pied Piper here and say that I'm certain that AI it's going to change the entire world, and I'm not a fanatic about this, but what I am is a trader, and I don't ignore a trend when it's staring me right in the face. I'm not going to fight something that if you do simple analysis, right? Like, is there a potential for this to be another dot-com bubble? Is there a potential for this potentially game-changing technology to cause a significant amount of growth in a specific sector? Yes, right? And we've seen how that looks before. You can look at, 1994 to 1999, because people refer to the dot-com bubble, but really it was, the personal computing revolution. It started in, the mid-90s, and it ground up. It just went up, right? At the very end, it goes parabolic. And that's probably when you say, maybe back off, right?
And it started with companies that had good unit economics that were either profitable, or they were, to the extent that they were unprofitable, it was because they could be profitable, but they just wanted to grow and focus on growing. And, Microsoft, was a high quality company.
Exactly.
It got traded very richly. Yeah. And then you had the real BS stocks. Pet.com is the classic example of, basically no revenue. And I don't know if Pet.com, it was trading off eyeballs. Eventually it gets ridiculous. And we were there in, late 2021 for a lot of technology stocks and SPACs. Citrini, I'm not a technology guy. I'm a finance guy. I'm a podcaster. And I'm also, not a biotech guy at all. So these things are way over my head. And this type of thing, like, even though I analyze macro, I always try and look at individual companies. And, normally most companies are not that hard to understand the basic business model. Obviously, so many complexities within, but it's like, oh, we get money from depositors at 1%. We lend it out at 4%, make that spread. We pay our employees. Boom, boom, we go home. Oh, we're a shipbuilder. We buy steel and we put it into ships. We sell the ship. Like, it's Chipotle, all these type of things. Well, when I look at the investor decks for all these companies, and I think most of this has to do with my noviceness as a technology person. Like, I really don't understand what all these companies are doing. I'll be honest.
I sympathize with that
Yeah.
because I don't understand a lot. I'm not super well versed in technology either, and I felt that way. I really felt that way when it came to like in 2021 with the like software as a service companies, right? I did not understand what these companies did.
What would be
Like
example of is a Snowflake be an example of that?
sure, Upstart, right? Like why would Upstart be worth so much, more than the traditional alternatives or I just
Monday.com.
right. Yeah, Monday.com, right? It's like, and I'm not saying that I respect the analysts that like understood that like that what was happening there. I didn't at all. But like when it comes to semiconductors and when it comes to, the data center and it's, it's not, I don't view it the same way, like with Supermicro, for example, that they are basically manufacturing boxes, assembling boxes so that other companies that need to put things in these boxes can, they're a box seller.
They
They,
literally
they,
just make the box.
they make the server. They make the thing that the GPUs go into. That's what Supermicro does. And
So they don't make
it's,
the chips. They just make the box, huh?
the unit economics are straightforward. There's a physical thing you can touch. It's not the software. I have a difficult time with, but this I think it's a little different. And also to something you said earlier, the dot-com bubble, there were companies that came out that just, what do you even do? What, you have no revenue. You're not even really a company. Like, can you name anything that's happened in regards to like ChatGPT came out in at the end of last year? It's
Yeah.
been almost 6 months now. Like, you know, I don't see anything that makes me think, oh God, the hype is insane. It's,
Yes, I agree with you, and I'll give you an example from a SPAC that I followed pretty closely. It was a gaming SPAC, unprofitable, and of course, and they make all these promises what they're going to make in 2027, and they had Snoop Dogg as a brand ambassador. And Snoop Dogg, and I'd invest with Snoop Dogg. I mean, I think he's a very
yeah.
smart guy,
Oh, absolutely.
but if you need a brand ambassador, you're spending all this money on marketing. I raises a lot of questions for me, and I mean, so many examples. Flying plane companies, they're not gonna, projecting that in, they're gonna make certain amount of money way far in the future, and investment analysts are like, well, actually, they're trading pretty cheap relative to 2020, relative to 2030 EBITDA, enterprise value to
right.
EBITDA, and then so I'm saying I don't see that now. Yes, Nvidia is up 180% year over year. I mean, definitely not a cheap stock, but a lot of the companies that you've written about on Twitter, and I assume you're either invested in, or you're bullish and you don't own it.
Well, you saw that I sent you a copy of the AI beneficiaries Substack post.
Yeah, so you're long, right? All that. Yeah, I got it. Yeah.
You asked me earlier about like the way that I invest, and I'm good at recognizing what I'm not good at, right? And
it's important.
I've never been sometimes you get lucky, right? But when it comes to like narratives that are affecting like single names, I'm not very talented at that. But what I do take advantage of are with trends are, you can create a basket basically. You create your own ETF, right? So another example of something that, when the economy started weakening in the summer of last year, I was looking for something to take advantage of the fact that inflation had, kind of made the cost of living higher. And at the same time, maybe there was a recession on the horizon. People were going to earn less. People were going to be out of work. And there's something called the lipstick effect. Are you familiar with it?
Because of our talk yesterday, yeah. But
okay, there you go. So well, then let's see. Were you paying attention? What you want to explain the lipstick?
All right, let's see. So when the cost of living goes up or people's incomes goes down, whatever. So in real terms, people's lives are getting harder. Their actual spending power goes down. People will spend money on things that are nice and maybe a little bit pricey, but are not actually expensive. Like, so instead of buying a new car, it costs $20,000, $40,000, $60,000. They're just going to buy like a really nice thing of lipstick, which I don't know how much lipstick costs. What, $50? I don't know. But
sure. Okay. No, but yeah, exactly. Right.
Yeah.
Couldn't have put it better myself. So that's
Instead of buying a
that's
house, I'm going to buy a really nice watch. Yeah.
right, exactly. So that's something that I wanted to take advantage of. Now I have less than no clue about how, like what cosmetics are hot, what cosmetics are not, right?
Yeah,
But
you're not like me. You know,
exactly, so I put together a basket of, cosmetic stocks. I went in and did, same thing you do with, any individual stock, but just, on a broader basis, making sure that they were beneficiaries of this trend that I thought was going to happen, and ended up with, I don't know, maybe 10 or 11 names. I went long cosmetics, Inter Perfumes, Givaudan, Ulta, Elf Beauty obviously was the biggest winner. And it worked, and as I got into it, it became very clear that, Elf, had kind of cracked this, it's not like conspicuous consumption, right? Like you don't put lipstick on and, or you're not using a type of makeup and everyone automatically, oh, that's Louis Vuitton, right? There aren't going to be little
no one knows what
LVs on
brand
your
lipstick
lips.
you're wearing. Yeah.
Right. Well, maybe there's a specific color or something like that. But regardless, that's the thing, right? So they seem to have cracked higher quality and at the same time, sticky brand loyalty, and then also at the same time, cheaper price points than their competitors, which is kind of the perfect way to capture this whole lipstick effect trend. The lipstick effect within the lipstick effect, and so that's just an example, right? And that's what I'm doing with AI. I've compiled this basket of beneficiaries, and I think it's up like 40 or 50% year to date. But
that basket is up 40 to 50% year to date.
Yeah, I mean, I have most of it is from like the past 3 weeks.
Yeah, exactly. Yeah, that's what I'm
So
saying. And
yeah.
I feel like bubbles in something where there's really nothing to it, they last like 3 weeks, a month. But I feel like if you have a bubble where there actually is something to it, it typically lasts longer than that.
Right. Yeah. The market is telling you there's something here.
And yeah, no one is long this stuff. No, you don't have people who are launching AI ETFs yet. I mean, actually, I think there is one, and there could be more, but they've existed for a little bit now. It can get so much more frothy than this. That's my point to the audience. And remember that I do know nothing about the actual fundamentals, but these stocks, unlike the stocks that were, let's say, in ARK, do trade at they are profitable. Not, some of them have an okay valuation. Some of them are very, very expensive, tend to be profitable with, of course, many, many exceptions. So how are you feeling about these valuations where, Nvidia before COVID had a price to earnings ratio of 20? Wow. Then it went up to 100 in late 2020. It sank down to a price to earnings ratio of 37 in October, for around 40. Now it has a price to earnings ratio of 200. And, that would be like a interest rate, you're earning 0.5% return every year, So if let's say the treasury bills yield 5%, that their return or their earnings, the price to earnings ratio of treasuries is 20. So the price to earnings ratio of Nvidia is 200. So you're paying 10 times more. So, and it's riskier. So tell me, walk you through how you own something that's so, richly valued.
First off, that's the last 12 months, right?
Correct.
So that's a big reason, right? The semiconductors are cyclical, and just like any other cyclical name, when they bottom and they start going up again, on a last 12 months basis, it doesn't look that attractive, but I watched the keynote from Jensen Huang, and really everything that NVIDIA is doing is primed to take advantage of this. Like the products that they have, the newest, supercomputer, the Grace Hopper 200, right? I mean, 256 graphics cards. They've made excellent acquisitions, like with Mellanox. Another point is, I put that whole basket out, and I included, a spreadsheet with it where you can go and you can look at the valuation multiples, and they're not all like that, right? There are companies that benefit from this trend that are not trading at 200 times price to earnings, Nvidia right now, I don't think that it is at 200 times price to earnings for the next 12 months. The reason that Nvidia trades that high is because it is executing so well. Jensen has been talking about accelerated computing and parallel computing for longer than probably anyone else in this industry. I'm relatively certain he'll be the richest person in the world at some point during the next decade. And I think that obviously, is it a wise move as an investor to rush in and buy something that's up 120 or whatever, off the lows? Yeah, exactly. Is that wise? No. But it's equally unwise to say this one stock is expensive, so meh.
Yeah, I wouldn't. Shorting it is
no, not even short. Well, this kind of comes back to what I said before, right? Like, if you're an active manager and you're long, like not owning something is kind of akin to
you're long IBM, which
you're kind of you're kind of expressing the viewpoint that what you own is going to go up more than Nvidia, and that might be a rational thing to express on Nvidia, just because the forward expected returns after such a significant round might not be as significant. But at the same time, that doesn't mean you had can you imagine? People think of the .com bubble and they think of 1998, 1999. And again, I'm not saying that that's necessarily what's going to happen here, but I feel like what we're looking at is a massive trend in technology that the market is starting to acknowledge. And can you imagine from 94 to 1999, and you're just like, can't do it. Sun Microsystems is too expensive. That would suck. So you can, there are so many companies involved in this process, and it doesn't make sense to just close yourself off from it. For example, I'm trying to think of another good example that is, let's see. Here's
Tesla.
No, I'm talking about like an AI beneficiary.
Oh. Well, some people say Tesla is an AI beneficiary.
Some people are wrong. So, yeah, like electrical component companies, right? Like Bel Fuse, Vertiv Holdings, makes liquid cooling. Units are very hot and they need to be cooled. That's the ticker is of VRT. That's another, it's just because there is excitement about it doesn't mean everything surrounding it is expensive.
What are some companies that trade at valuations that a value investor could get their mind around? And I think maybe was it Micro Sun? What was it? God, what was the company that you were long that has done ridiculously well?
Super Micro, yeah. Still trading at a 6%.
Super Micro was cheap, and now it's up 300%, and it's still price to earnings ratio
still
of 20.
Cheap. 20. Yeah. I mean, free cash flow to enterprise value yield of 6%. That's better than the median in the market, right? So that's a perfect example. If you want to see like an entire list of companies like this, that's basically what I publish on my Substack. I think I'll say that internationally speaking, Taiwan is a difficult market to buy single name equities, and there's paperwork involved. But if you are so inclined, I think that the valuation difference between Taiwan and the United States for companies that are essentially identical in terms of potential upside for this theme, it's so significant as to almost be an arbitrage, right? Like you have companies that are so much cheaper.
With the exception that there's a chance that Taiwan might be taken over by China, so that's trading at a geopolitical premium or steep geopolitical discount.
Yeah, you're earning the geopolitical risk premium. And, and that's certainly something to consider, right? To close off the last thing that we were talking about, there are plenty of stocks that are U.S. listed, right? Here's one that's probably cheap on the next 12 months. Smart Global Holdings.
I checked that. Yeah.
Yeah. There you go. There's one. So Fabrinet
too, right?
Yeah, Fabrinet too. And for example, just if we were going to say, as far as Taiwan is concerned, I mean, there are some Taiwanese companies that are basically that are trading at like one times the last 12 months earnings, like
Like what?
Light On. Then there's Acton, which another supplier. I believe that they are a direct supplier for, or Pegatron, right, which makes the servers, uh, server racks. I mean, that's these companies are trading insanely cheap, right? Like, and this is potentially a mega trend, and also it it, it makes like basically just open your computer,
Oh, and
it's like
see who makes it. Yeah.
I mean, that was really a very like significant winning strategy in 2023. Just like open your computer, and if there's a name in there, buy it. But it's interesting, right? Since this is a macro focused show, the if this does turn out to be as significant as I personally believe it is, it'll be very interesting to see how it affects capital flows and the if you think about the amount of computing equipment that'll be needed to be purchased, it could be significant. It could significantly affect flows into the Taiwanese dollar, right? And the Taiwanese dollar is a significant funding currency for carry trades, and so that could be like an interesting. There might be a blowout lurking under the surface in Taiwanese dollar.
Sorry to interrupt. Wanted to let you know about Blockworks' upcoming crypto event, Permissionless 2. This ultimate DeFi gathering will be taking place in Austin on the 11th to the 13th of September 2023. It will feature the very best discussions on ZK tech, rollups, account abstraction, MEV, and much, much more. All the big hitters in crypto are going to be there, so if you're into crypto, you need to be there too. To get a 20% discount to a full 3-day pass to Permissionless 2, click the link in the description and use code GUIDANCE20. That's GUIDANCE20. Thanks, and let's get back to the episode. Got it. That's interesting.
Right.
Yeah, I guess there is the element of, if you have a hardware business, those margins are sometimes not as good as a software business. So like Intel, they make a lot of stuff that's in Microsoft computers, but Microsoft's the one that makes all the money. And so, some of these stocks are trading at a cheaper than, these cloud businesses. That might make sense. But yeah, I mean, 1 times earnings sounds pretty extreme. Tell me about the losers about this, because they're companies that were SaaS businesses that traded at a high valuation over the past 10 years and deserved to, because they were growing 30% a year and were profitable, even if it's on some adjusted metric or something like that. I was seeing you write about how some companies are actually going to get screwed over. Some companies will not be beneficiaries. They will be, edged out of the way. What kind of companies are those?
Well, so have you ever used Fiverr?
No, but I know what it is.
You know what Upwork is?
I've heard of it, but I actually don't know what it does. Similar thing?
Okay, so yeah, basically, and Fiverr especially, right? Fiverr's like the reason it's called Fiverr is because it's not still like this. There are it's not all, but basically when it first started, it was pay someone $5 to do a menial task for you, right? Like you need to format this spreadsheet, or you need a quick graphic design job done, or so, you need someone to write a letter for you or something. You don't have time to compose personal letters to 20 different people. That's what Fiverr is, and coincidentally, that's also what ChatGPT is. So, I mean, you look at Chegg, right?
Yep.
Chegg, kind of the first, perhaps like the quintessential AI loser. They basically had a product that enabled students to cheat, I guess.
Yeah,
It basically was the business model, right?
yeah. I guess
Correct me if I'm wrong.
I feel like real true cheating is cheating during a test, like coming in, writing something on your arm or something. But
Right,
it allowed, yeah. It would tell you what happened in Huckleberry Finn, so you didn't have to actually read Huckleberry Finn.
right, so exactly, right. So,
And ChatGPT is very good at that. And the stock tanked in February, March, big time. Yeah.
exactly. So I don't know that much Python, but I asked, GPT-4 to do it for me, and it did it, and it works. I was paying someone to do that on Upwork before,
Mm.
and so that seems like a pretty significant loser. Just for example, like something like LegalZoom, right? I'm sure that lawyers are going to fight back against. I saw there was something where an attorney wrote a brief. Did you see that? Wrote a
No, I
brief
didn't.
using ChatGPT and got caught.
Does LegalZoom use AI?
No, I don't think so. So that's the thing, right? Like, if I want to set up an LLC, basically I can do it myself, right? I can file for an employer tax identification number with the federal government, and then I file with my state to get articles of incorporation, and that's that. And LegalZoom will do that process for you, but it's a very straightforward process. And ChatGPT could fill out those forms for you, tell you where to send them, tell you where to submit them. And
Yeah.
I think that's, but again, very speculative with this kind of stuff. This isn't, I have better things to be short, I think, than like, unless the company is like significantly, like not in great shape otherwise too.
This has been a lot over my head. Thanks for sharing with me. I'm a finance guy. Let's stick to finance. So you tell me, Citrini, that you traffic in a lot of things. Rates, commodities, stocks, volatility. Maybe. Let's see. I'm gonna throw a few things out there. What do you think about the 10-year Treasury? Where do you think that's going, and why?
I think that it's the rich, probably. Yeah, rich for sure. There needs to. I think yields should probably go higher. I would not be surprised to see yields retest their highs
Above 4% for
on the
10-year.
on the
Okay,
10-year.
got it. Okay, let's continuing the lightning round. What do you think about bank stocks? I mean, you can throw out individual names. I'm familiar with a lot of the names, or the XLF, which is like 12% Berkshire Hathaway, Bank of America, blah blah blah, or KBWB, which is an ETF of the regional banks.
I think that. Okay, so bank stocks, basically regional bank stocks, right, are basically. I would probably stay away if you were going to play it. I do think that KRE might have put in a decent bottom back there around 30 35. I think the better way to play it was with the preferred stock. Obviously there was a ton of upside on some of these names, but some of them are going to see their net interest margins compress, and it's going to be a very tough environment. It looks like the yield curve is going to stay inverted for a little while longer, especially after the jobs print today. And it just seems basically that I would like to be. I picked up Comerica straight bonds. I think they're
straight
20,
bonds. What do you say?
Yeah, and for like a 11% yield to maturity back a little while ago. I also picked up a couple different preferreds. I got First Horizon back when the deal broke. I picked up First Horizon Series A for or sorry, First Horizon Series B. Sorry, for it's like $16.08, and
$16 and par is 25. So that's, I'm not
right.
good at math, but that's
like, yeah,
60% par a little, yeah.
Yeah, and the thing is, they are they're perpetual, right, and non-cumulative. So if the bank gets into trouble, they can suspend the dividend, and
and these securities are quite complex, so people should. Yeah.
Right, but at the same time, it was super overblown. That's the way I played it with the preferreds. I think that if you want to get involved in like regional bank stocks, do your research. Like make sure that there are probably some good deals out there, but at the same time, you know, they could go lower. So I think I would probably I was long KRE. I sold it right around middle of this week. I think that it might have a little more upside left, but I think if you're going to play in regional bank stocks, you have to make the commitment to go after a name that you are willing to learn about. I think like Bank of Hawaii might be a good place to start.
Oh, I've looked into Bank of Hawaii.
Yeah, there's a
I don't own it, but
banking is a lot different in Hawaii than it is in like the continental United States in the sense that there's a lot less competition. And if these banks were to get into trouble, it would be very likely for someone to buy them out just because it's been a very difficult market for the larger, big banks to break into. So that might offer you a margin of safety.
hey there, sorry to interrupt. A lot of Forward Guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some Forward Guidance listeners are into crypto. Some own crypto, a smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code guidance10. Thanks, and let's get back to the interview. Got it. Okay.
Let's keep going. I like this.
All right. Price of gold.
Price of gold down.
Down. Why?
Because it's a real rate proxy.
Real rates will go higher?
Mm-hmm.
Why? That's inflation-adjusted rates, probably based on inflation break-even, so not actual inflation, but future inflation expectations. So
I have a bullish bias on the dollar. And
why?
I think that the narrative got a little overblown in the whole de-dollarization, the reserve currency, the dollar hatred. I read something. I think it was from Exante data.
Oh yeah.
Yeah, a great history about like dollar hatred through the years, right? And
yep.
I don't see a scenario where the renminbi is like the world's reserve currency. I think that basically, dollar hatred is cyclical. I also think that for a while, like Christine Lagarde fooled me. Right, like it was like she came out and I was like hyped, right, because I was long the euro at the time, and I'm like, Christine Lagarde just had her Draghi moment, and like she is gonna whip inflation now, and like this is the ECB is getting shit done. Can I say that?
Yeah, for sure.
Okay,
so now you mentioned Christine Lagarde. Where do you think how high do you think the ECB hikes its rates to? And I guess the terminal rate that's now being priced in is like 3.8%. And what is this? Let me see what the spot rate is. ECB deposit rate now. 3.25% now, around there. And again, there's a deposit rate. There's a lot of main refinancing, a lot of different things as you know. But so it's at 3.25%. Market thinks they'll get to 3.8%. So 2 more hikes. Do you think they do more, less, or the market's right?
I think they do whatever the Fed does and then one more. And so I think
so the Fed's and that's what's being priced in, right? So do you think the Fed does another one? Do you believe this whole skip that we're going to skip in June and then we'll hike in July, or is that just a little narrative?
No, I don't think so. The Fed understands that once they stop, there is something to be said for like when you're positioning yourself, right? It's important to not position on what you think the Fed should do, but position yourself on what you think the Fed will do, right? Which are very different things sometimes, most of the time. So in terms of the next FOMC, I really don't see a reason why I think they know once they stop, like that is, it would be very difficult in terms of, the Fed doesn't want to do something that the market isn't already pricing in. And once they stop, it's going to be very difficult to get, the short-term interest rate futures to price in them starting hiking again.
Correct.
So,
Right now, it's
but
pricing in 70% chance of no hike in June in 2 weeks. And so, if that's true and they don't hike, then they won't hike in July for the reasons you said. And therefore, if the Fed does 0 hikes from here, that means the ECB will do 1 rate hike. So that means the ECB would get to 3.5%.
right, like the ECB might, go off on its own, and we might see like multiple meetings where the ECB hikes and the Fed doesn't, and then. Like after Credit Suisse, that they had a little bit of a tone change, and I don't think that's the case anymore. What I'm really interested to find out, if you look at like the Bank of England, and you kind of, if you look at like where break evens for linkers are trading, like real rates and forwards, uh, real rates are basically like I think 1 or 2 years forward they're at like 30 basis points, and then like 5 years forward they're at zero or so. I have to look
Inflation's
again.
at 10%, 12. What?
Right. So I'm talking about forwards, right?
Right. Yeah.
Right. Yeah. Yes. And so that's what's really interesting to me, because like I like, first off, I think that Bailey is like not the most competent central banker. Like if there was like a central banking competition to save my life, I would not want Bailey to be like representing me. But I think that uh, basically yields on like a 10-year gilt are nearing where they were when they had the pension crisis. And the thing about that is like when you get to a level where like something broke before, uh, it's like on the old maps, right? Like here be dragons. It's we don't know what happens if we go above that, and it's just they are in such a bad situation. It'll be very interesting to see if the ECB pauses and the Fed pauses. It's on one hand, it's very difficult for me to see the Bank of England like continuing to hike. On the other, like I don't want to see what happens to the Great Britain's inflation rate when uh, if they pause just to follow the other global central banks. That'll be tricky.
Got it. Thanks. Okay, so final question. What about the stocks? We're at 40, above 4,200 now for the S&P 500. You bullish, bearish, neutral? What do you think?
I'm bullish. I think that I don't think that we could a pullback would probably be natural. I think I think we might see maybe a pullback back to like 4150 or so, but I don't. It's nothing that would stop me
You're
from like
bullish. Yeah, you're
staying
bullish.
long.
We
Yeah,
don't,
I'm
we don't,
bullish.
you don't have to double pull. Yeah, you're bullish. That's cool.
Like I've been bullish for like since October and November, but
I'm jealous,
it's like
bro.
it's just difficult, right? Because like I'm not, I'm not, I don't have blinders on. I see that like it's a very confusing macro environment, but at the same time, in the past, the times when I have been successful making decisions in stocks off macro was not confusing at all. It was like very, very straightforward in the sense where I could pull up, like 4 of the most common macro indicators, like, non-farm payrolls, GDP, inflation rate, the initial jobless claim. Just, I don't have to like delve deeper. I just, like the macro decision of like the Fed is going to raise rates in, back in like the late 2021, the Fed there are like, hoofbeats of quantitative tightening. The Fed says they might have to raise rates. Inflation is ramping. It's been, above 5% for the past 2 months. That's straightforward,
Short bonds. Yeah.
and that, yeah, short bonds, sell the risk assets, sell the equities. I have not had great success in the past where it's like, oh, the macro is too confusing. I better like get out of, the assets because like everyone else is going to, obviously some people know what's going on, but like on average, everyone else will be confused too. And it
Right. So
seems
how have
like,
you been so
yeah.
successful if the macro's been so confusing? Has your alpha not been based on macro? It's been based on other stuff?
Well, I mean, it's a lot of it is just, fading sentiment, right? Like the reason that I got long in October didn't have anything to do with it. What it had to do with was, first off, in the beginning, I was right for the wrong reason, right? I saw the Bank of England crack in terms of, with the pension crisis in the end of September. And that was kind of like, okay, like maybe we're getting into an area where they have to start, easing it back. That, and also it just, everyone was like certain we were going to have a recession. Cyclicals were actually absolutely smashed. So it just seemed like, okay, even if we do have a recession, if I get long here, it seems like unless the recession's severe, I'm going to make money. And like when it comes to trading, like macro thesis is good, and overarching regime, knowing what that is, it's great. But at the end of the day, it's all risk reward, right? It's how much money can you lose versus, how much can you make? And that's, if you don't understand that, then you're never going to make money trading, just because, if you just have your thesis and you're 100% convinced you're right, then, and maybe you even are right, but the market will not cooperate with that. So the reason that I've been successful is just risk reward. It has nothing to do with, whether my macro theses have been right or not. I had some decent calls, like I said, selling growth and risk assets in, late 2021. And, I did, catch like the summer bear market rally, but mostly again, just risk reward.
What about price of oil? Now, what, about $70, and then oil stocks, but oil first.
I mean, I recently got long oil, literally like 36 hours ago. It was like a late night, I, I got in like a good, I got in at about 60. I tweeted at like 1 a.m. I was like, I'm going to go long oil a little bit. It just seemed like, I was speaking to like oil traders, and I was like, what is going on? Like, is like the energy complex convinced we're having a recession? Because, I'm not really seeing that. And, it's like oil kept falling off a cliff. Meanwhile, like, it just didn't line up with the whole cross asset picture. And, so they were like, I don't know. And, it just seemed like a very, washed out sentiment type thing. So I'm in it for a short term trade. It seems like, as OPEC is apparently intent on making speculators ouchy. I don't necessarily know what that means. I guess I'll be on the side of OPEC for now. So I'm long oil for now.
All right, final one, Citrini, I promise. What do you think about the Bank of Japan, the yen, and rates on JGBs, Japanese government bonds?
Well, so in December, back when Kuroda was here, I miss him, but it was like very straightforward in terms of what everyone thought was going to happen, and then I've been pretty bullish on Japanese equities, just in terms of the differential between, the rest of the world is tightening, Japan is keeping easy. And it seems like Ueda came into his position, and what I was expecting was not necessarily a quick policy normalization, but I was expecting a little bit more of a change, right? That he would, do like SFSO or, just anything to, get away from yield curve control. But I think what I didn't realize necessarily, or what I didn't attribute enough weight to, was that, inflation in Japan has been something that they have been trying to achieve for, multiple decades. And it's very difficult to be like, if you're Ueda, you want to just come in and be like, okay, we're normalizing policy now. Like, it's cool, we got inflation back, positive for the first time in forever, but let's see what happens when we, raise rate. Nobody wants to be that guy that like ruins, like 3 decades of work. So he seems to be very measured about it. I can't blame him for that. It seems like the Japanese economy is finally picking up, and that's kind of, I guess Kuroda's legacy, along with a bunch of other stuff. But I think that basically the way that yield curve control is going to be unwound, it's not going to be how the market expects. just like with anything else in the Bank of Japan, I think it'll take a lot longer. I was short JGBs back in September when they did the first yield curve control adjustment, and now it's looking like probably the Japanese bond yields are going to stay right where they are. And in terms of the yen, I think that right now the weekend is beneficial to Japan, and I think that if it got crazy again and it, got totally disconnected from U.S. rates and, started spiking like how it was, last summer, then they would do FX intervention again. But I do think there's still some downside left on the yen, as the market fully realizes that the differential, the Bank of Japan is staying dovish for now.
Got it. And you're still bullish on Japanese equities?
I am, yeah.
Got it. Cool. Well, thank you so much, Citrini, for joining us. People can find you on Twitter at Citrini7 and your Substack, citrini.substack.com. Thanks so much for joining us, and thanks everyone for watching.
Thanks a lot, Jack.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.